If we look at the performance of the F&B, obviously, like we mentioned, it's for a lot of regions and different types of asset classes. So if we look at luxury or full service, this is the segment, the revenue stream that is already also it's also important. It's very crucial, and on the basis of per available rooms basis, we can see a big drop here in majority of the regions, up to 90% year-on-year change on a per available room basis. If you look at the outlet performance per occupied rooms basis, we've mentioned that already before, that obviously hotels are being hit because of the fact that there is lack of demand, but also because of social distancing. And with Asia Pacific coming, into where the revenues and the operational levels are increasing and almost coming to normality, we can see that, for example, bar revenue is decreasing year-on-year anyway, because obviously of the social distancing measures that are being implemented. Similarly here in the Middle East, that's a similar picture in the restaurants with the social distancing measures implemented, and this is what's also been affecting performance in that region. We also were talking about room service. This is the area that before and historically has been rather neglected and not considered very significant by hoteliers. However, in 2020, that was an area of opportunity, with the Middle East taking advantage of it, and you can see an increase in room service revenue for the Middle East, 76% on a per occupied rooms basis year-on-year. Now with payroll, this is something as we've been reviewing as well and looking at the impact of payroll and labor costs on per available basis, and how is it changing? Will it change for good? It's something that we've been considering in HotStats. Obviously, the picture this here differs quite a bit because of different levels of support that's been available around the world. With Germany, UK, for example, in Netherlands, you can see that the payroll levels are not coming back because of the support that has been available and given by the government. Whereas with the UAE, the support is not there. Certainly not. They have not been receiving that much of support. And even though the UAE at the moment is coming closer to what in terms of operations and demand to what it was before last year, the payroll cost is still not getting to the same level. So we'll see how this will then progress. We'll be monitoring this in the next few months, because we'll be receiving obviously much more data here at HotStats. Now, another thing that we wanted to look at is obviously with the regions returning, will there be any changes in terms of the P&L structure and in terms of labor cost or even other expenses? Will the makeup of the P&L be changing year on year? So if you look at the sort of recent data that we've been receiving from China and a per available room basis, per available room basis, the payroll cost actually so payroll cost is decreasing, particularly in the undistributed departments. So at the moment, China, even though, like I mentioned already, the demand is returning and the revenue is returning to that region, the overheads at the moment are reporting at about 15 to 10% level lower than last year, or than before the crisis. If you look at distributed departments, the picture is a little bit different, because what we found is that here, obviously on the slide is like I said, per available room, so it shows it's a little bit lower. However, if for distributed departments you look at the per occupied room basis, then it seems like it's actually the levels are stabilized at the same cost as it was before the crisis. Similarly, these are overheads for the UAE. So again, it's an early picture, but like I said, the UAE is returning, the demand is returning, and at the moment they're experiencing higher season. I think the revenue levels in December were about 15% lower year on year. So actually, considering the situation, that's not that was a very good performance. However, if you look at the labor costs in overheads, these are still showing a really big decrease, to 40 to 60% less year on year. And that's even in December, like I said, even though the country is returning, the demand is returning into the country. So on a global picture, if across the major regions, obviously, undistributed expenses, even though we consider them fixed, they've decreased significantly, with sales and marketing predominantly, because of which is obviously linking to the marketing fee. That department's been hit the most, but we can see also admin in general, particularly in Europe. And in general, across all the departments, we can see significant changes, and hoteliers pulling the costs back. And obviously, in some regions, again, governmental help also was received and helpful here. Now, if we look at other costs which don't include payroll costs, and this is again an early picture from China, where we've been sort of monitoring and wanted to see if there will be year-on-year changes in terms of, and will there be a savings and so on. We can see that actually on a per available rooms basis, China is the costs, even in overheads, they will be returning. They have returned, or almost already, to the levels from before crisis. Maybe apart from the sales and marketing fee, but it seems like this will coming back as well. And the last point is the break even. As you know, we've been monitoring it quite closely in the last year. And on the left-hand side, you will see these are break-even levels for regions and for different asset classes from before the crisis. And obviously, on the right-hand side, we've got rolling 3 months, with actually break-even points being lower than before the crisis. And particularly, what's worth noticing is countries with Europe, for example, managing to achieve a much lower break-even point, with all the government support that was being received. And no wonder, with regions like APAC or the Middle East, it's not really the break-even points in those regions were much higher. So in the summary, provincial coastal cities will outperform the key cities. This is a picture in the UK, Europe, or globally as well. Extended stay properties have performed better than full service hotels, and also than luxury hotels throughout the crisis. We think that we'll see in terms of hotels being open leaner. There is a lot of evidence that will be the case, particularly in terms of labor. However, to see the impact of that and what's going to happen in Europe, this is still we will still need much more data to be able to see that. We had before as well the direct operating cost increases. So I was showing multiple times already the slide where we experienced significant increase in terms of operating costs on a per occupied room basis at the height of the pandemic, but these have returned to normal now, and they seem to be at very similar level as they were before the crisis. And obviously, we definitely can see the government support, and that has really helped the hotel performance in Europe. However, is this distorting the change in cost base. So this is from me today. Thank you very much, and I'll pass on to Philippa.
You're not quite finished yet, Aggie. Just a couple of quick questions which have come in while you've been presenting, if that's okay. Chris Tarrant asks, are the measures per available room based on total room inventory, or just room inventory in hotels that have remained open?
No, it's based on total rooms and inventory. So we, as HotStats, we've been using the total rooms inventory, not only from the hotels that which are open.
Right. Okay. And Charles Prue asks, he says the 16.4% payroll cost shown for the UK is around the same level as hotels operating without F&B. So does Aggie expect there to be a huge change in payroll cost once hotels are fully operational?
So
Do we expect payroll costs to revert to something near what they were pre-pandemic?
So, like I said, I mean, this is a really interesting question that we all are, asking ourselves. Is definitely one thing that we need to take into account is the government support, right? So, at the moment, if we look at any figures from Europe, they will be distorted because of the support that is being given. And I think the question is that if we, at the moment the support stops, this is when obviously the levels, the payroll levels will be coming back. However, if they will come back to the same levels, I think there is a lot of scope that, particularly in overheads, there will be some, there will be some scope, and there will be a possibility that actually we will see a bit leaner properties. We've done also some, a few interviews recently, because we'll be releasing annual publication by HotStats, where we've been talking to operators and owners and so on, and I think they're confirming that when the hotels will start getting back to normal, then there will be much stricter approach and much more analysis involved into employing, new people and getting new FTEs, reported and employed by the hotels. So I think the early outlook will be that actually there will be a lot of, savings in payroll costs, and then we'll see how the situation progresses, at least at the beginning, and then obviously we'll see how the situation progresses.
Thank you. Another question just around ADR, which you haven't spoken a lot about, but evidence in the UK would seem to be, and this is particularly leisure market, I'm not sure if it's the same in the corporate world, but perhaps you can shed a bit of light, but evidence would say that rates have not been severely dented, and that actually the expectation here to be that as restrictions lifted, that people should expect the same sort of levels of ADR, if not slightly higher than pre-pandemic. What do your statistics show on a sort of UK, Europe-wide basis?
For ADR, to be honest, I'm not sure. I'll have to check, but I think from memory, we've seen that it's mostly all about occupancy. I mean, obviously, I would have to double check the stats on when the demand returned, if the rates were the same for the UK. It's possible that maybe Mike, he's on the phone, he might be on the call as well. He might be able to answer that question a bit better.
I can answer.
Mike, can you shed any light on?
Oh,
perfect. Okay, thanks, Philippa. Thanks very much, Philippa. That's great. David Bailey, I think you're there. Interesting that previously assumed fixed costs have been cut very significantly. I mean, do you think that as the world returns to normal, that operators will manage to keep a lid on some of those fixed costs and keep them at a level lower than they were pre-pandemic? Or do you think that, as has tended to happen in the past, things revert to normal very quickly?
I think there will be some residual benefits. I think, given that there's been a root and branch review of costs, and there was a wonderful expression someone used early on about unfixing the fixed, Roddy. And I think, therefore, as one builds costs back into the business, I think people will naturally scrutinise those. And as long as that vigilance is maintained, I think there will be residual benefits. That's certainly the hope. It would be a great shame if we just reverted to type. But I think this has been such a profound impact and change for the business generally. It's been an accelerant to adapt and review how we do things. So short answer is I'd expect a residual change. Big question, I don't know how much. Okay, and David, also not a point you've touched on, but I know that you're very well informed about the industry generally and the whole area of M&A and so forth. But my question is more around the banks. Clearly, the banks have been very focused on supporting
their existing clients through the various government supported schemes. And indeed, they continue to do so. And from personal experience with RBS, they were quite clear that they won't be getting involved in any new to bank lending until Q4 of this year. Looking at relationships between businesses and their banks, I've also picked up purely anecdotally that the banks are likely to take a bit of a tougher stance as we come out of this than they did perhaps after the global financial crisis. So do you have any sort of feel of how the banks are likely to react, particularly in relation to clients or customers who may be struggling somewhat?
That's a really good question. I mean, I wear a number of hats, Roddy, and certainly with my sort of CBRE consultancy hat on, there are debt experts in the business that could opine extensively on that, and maybe that's the thought for a future call. I think a couple of things quickly. I mean, banks have been supportive. The government has been highly supportive. Absolutely, it's been easier for those with established relationships. You're absolutely right. New to business is a challenge. Development finance, I think, is a challenge. So there has been an impact to loan to value margin and margin itself in terms of pricing of that debt. I think what we are seeing, though, that is different this time is there is non-bank debt out there. We have PE funds that have debt funds. We have other disruptor banks that are in the space. So we talk a lot about our, let's call it the high street sort of main brand banks. There is a much broader spectrum of capital that is available, and that capital will be, some of it will be very aggressively priced, some of it will be more sort of collaborative, if you like. There's opportunistic capital out there. So it's not a straightforward answer, but to the point about banks will want to, if you like, rationalize and correct their positions when the government support sort of eases off and when businesses open. And that's when they've got to look to the businesses about their prospects, their performance. Will there be, I think I've mentioned in a previous call, we'll start to see a churn in portfolios, perhaps as some assets are traded to right-size loans and get that loan to value rebalance. So yeah, it's going to be a mixed picture, Roddy, and is the short answer. But there will be a lot of choice, I think, for capital sources, depending on your needs as a business and how much you want to engage with those different sources of money.
And a lot of the people, just to follow up that, David, a lot of the people on the call are owners of independent businesses, yeah, who clearly have less leverage and clout with their banks. And I'm sure that some of them are, finding life incredibly difficult at the moment. Have you got any advice for independent business owners who are sort of right up against the wire in terms of how they could potentially find support from other sources?
God, that's a tough one. I guess, for those businesses, and I appreciate when you're a small business, there is so much that is resting on your shoulders in terms of being able to call on wider resources. I think just before I get into that specific part of the question, what I am encouraged by, when you look at all the sort of the mood music and information, we're looking at sort of staycations round 2. Andrew Sanks has been talking about the amount of money that people have got pent up in terms of their personal balance sheets, where they want to spend this, the likelihood that we're not going to be able to go abroad. I think I don't know if we did a straw poll on this call, Roddy, how many people are actually trying to commit to holiday plans. So these independent businesses, if they're in leisure destinations or they can access leisure markets, I mean, I think we could, bizarrely have a rapid shift into a sort of fill your boots moment, because, and that's a real challenge for these businesses that are going from lockdown to sort of unlock open in one move. But I think there is the opportunity for very, very significant uptick, and Aggie's figures talk to that. So I think from a banking and funding perspective, if one has got one sort of planning and information, if you're on top of that, you've got a story that you can articulate either with your current lenders, or there are lots of advisors out there that one can engage with. I think a challenge for the independent businesses is the lot size of the loan quantums they're talking about can then be a challenge to engage. But I think generally it's finding that right advice. I don't have that right now, but I do think they're in a good place potentially for what could be a rapid uptick. I think the real challenge for the sector is in 2022 and beyond, when UK residents can travel abroad, we're going to have increased competition. So it's really, and you made a point about average rate, and I think there is there's a real opportunity to drive pricing, not in an exploitative way necessarily, but certainly don't discount. There could be some real price tension. And if we start having summer terms extended and summer holidays shrunk, well, that could really exacerbate sort of peak demand pricing as well. So, I hope to goodness we see some staggering of that to the benefit of the sector. But I mean, talk to your bankers, and if you're not making the progress you want to with them, then I would suggest look to engage advice as to where else you can go.
David, thank you very much. I mean, on that point, if anybody is really struggling and wants some advice or wants to know who to talk to about getting further advice on how you get through this sort of very difficult period, do give me a ring, and I'm sure I can put you in touch with one or two relevant people. David, thank you very much. Aggie, thank you very much. Very insightful and informative as ever. I'd now like to welcome Philippa Goldstein. Philippa is new to our calls. Philippa, thank you very much for agreeing to join us. Philippa is has a background in hotels, so she's not just a desk jockey. She actually has been out there and worked for companies in the sector, including Queen's Moat Houses and I believe IHG. I'm sorry, I haven't got your biography in front of me, Philippa. But Philippa is the senior hospitality and hotel analyst at Knight Frank. And she has agreed to join us today to give us an insight as to the world as seen from Knight Frank. So Philippa, without further ado, can I hand you the baton, and perhaps you can give us your views of the world and which direction we're heading in.
Yes, hello, good morning, everybody. Can you hear me okay?
Absolutely.
Can you hear me
fine.
okay? Fine. Yeah, thank you. Yes, so I head up the hotel research at Knight Frank, and I'm responsible for producing all our specific hotel research. This morning I'm tasked with talking to you about the regional UK hotel trading performance. Over the last few years, we have produced a detailed annual trading performance review using HotStats data through our own analysis, and we use data sets of different hotel classes. Obviously, though, since the pandemic struck, since around September time last year, we've revised our research to focus more on the current trends and the monthly reporting. And so out of which we've produced what we call the Knight Frank Hotel Dashboard. And so I'm going to share with you some of these trends in this morning's presentation. And it reviews the different hotel data sets. Specifically, this morning, we're going to look at regional UK and focus on select service hotels, mid-scale hotels, full service upper upscale hotels, and also the golf and spa market. So this chart is looking at.
Philippa, could I just ask you to, I don't know if you can tilt your screen a little bit. We can only sort of see your eyes on the top of your head.
Oh,
there,
sorry.
that's marvelous.
Is that better? Sorry, apologies.
Just nice to be able to see the whole face of whoever's talking to us. Thank you very much.
I do apologise. Okay, so this slide shows TrevPAR, and as you can see, there's the four charts showing the different data sets. I'll just hide. Okay, so the November lockdown resulted in a month-on-month occupancy across regional UK, declining by 16% for full service upper upscale hotels, and by 11% for select service and upper mid-scale hotels, but a considerable 32% fall in occupancy for golf and spa hotels. Although I haven't included it on this slide. The extended stay sector only saw occupancy decline by approximately 5%. Average room rate declined by about between 5 and 7% for select service and upper mid-scale hotels, compared to 11% for full service upscale and upper upscale hotels, and 10% for the golf and spa hotels. As a consequence, in these steep declines, it's caused a steep decline in RevPAR, with select service hotels recording a 36% decline in RevPAR between the month end October and the month end of December. Mid-scale hotels witnessed a 43% decline, while RevPAR for full service upper upscale hotels declined by between 52 to 53% between the same period. So you can see the devastating impact that the November lockdown has had. TRevPAR for golf and spa hotels, and I say TRevPAR, not RevPAR, because for golf and spa hotels declined by 70%, and it's more important to look at TRevPAR for these hotels due to the importance of incremental spend. For the last 2 months of 2020, regional UK select service hotels and mid-scale hotels were proven to be slightly more resilient, achieving a stronger RevPAR than full service upper upscale hotels. They leveraged a 15 percentage point higher occupancy between select service hotels and upper upscale hotels. And that's for hotels which were open. In terms of F&B spend per available room, full service upper upscale and upscale hotels witnessed revenues down by 90% compared to 2019. Yet they managed to achieve a stronger TRevPAR performance than both select service and mid-scale hotels. Full year RevPAR for regional UK averaged approximately £23.50, and there's very little difference between select service and the full service upper upscale sector. The average TRevPAR for regional UK equaled about £37, with full service upper upscale TRevPAR of £40, and this compares to about £29 for the select service market. Regional UK hotels and spa market have shown strong resilience on an annual basis. They've achieved 27% uplift in RevPAR compared to regional UK, between the regional UK average and TRevPAR of £75. This is double the regional UK market-wide performance. Whilst this is not unexpected, it does show that the golf and spa market have performed strongly when the hotels have been able to trade. This next slide shows the difference between the data sets for the total costs versus TRevPAR, and with TRevPAR shown by the line on the right-hand side axis. Golf and spa hotels can be seen, as I just said, to have performed strongly during the summer months when allowed to trade, with TRevPAR performance far exceeding their costs in August and September. However, as these charts show, full service spa hotels and full service upper upscale hotels have had much higher fixed costs, and we will see later in this presentation how this impacts on profitability. When undertaking an analysis of open hotels versus hotels which are closed, whilst during the months of lockdown on certain occasions, departmental total gross operating income for closed hotels may exceed the gross operating income of hotels which have remained open. Hotels which remain open have a significantly enhanced gross operating income for months when they are allowed to trade. This demonstrates the value of having an operational, proactive sales force in place throughout the period of lockdown. Moving on to have a look at payroll. This makes a distinction between departmental costs and distributed payroll costs, and looking at the change the change year on year. So for the same period the previous year. For all graphs, with the exception of the select service hotels, you'll notice a greater degree of cross-cutting across the data sets in the departmental costs. It's possible that the select service hotels have stayed open more during the lockdown and have therefore had higher occupancies than compared to full service hotels. Their ability to make full use of the first furlough scheme has therefore been more challenging for these hotels. Furthermore, select service hotels typically operate a lean business model, and their ability to reduce payroll costs and other costs is potentially more limited. Select service hotels have remained open to business throughout lockdowns. Those hotels that have remained open to business during the lockdowns have witnessed a 33% decline in average room rate between the month of May and December, yet only a 2% decline in operating payroll per available room. This decline in average room rate is significant, and combined with falling occupancies, the room's profit margin equated to 33% in December, and this compares to 61% the previous year for the same months. Total payroll costs for full year 2020 averaged 43% of total revenue across all regional UK hotels, compared to an average of 30% for full year 2019. So the next two slides are focusing on profitability. We look at GOPAR and GOP as a percentage of turnover. With the national guidance to stay at home, the severely restricted trading conditions have resulted in the UK hotel market to become loss-making during November and December 2020. For all hotel data sets, with the exception of the service department sector, that's the case. However, for those hotels which took the decision to remain open for key workers and business travel, the hotels were able to mitigate some of the losses, with the negative GOPAR greater in hotels which remained closed. Both select service hotels and upper mid-scale hotels have remained profitable up until November, but GOPAR and GOP percentage of total revenue declined sharply in October, before turning negative thereafter. This was largely due to the steep decline in average room rate and the costs not declining by the same margin. For the full year 2020, hotel data sets for all hotels which were open as at December 2020 have seen undistributed operating expenses reduced on average by between 36 to 41%, with sales and marketing costs reduced by up to 57%. However, the sales and marketing costs in the HotStats data does include franchise fees, and so lower franchise fees are consistent with lower revenues. And utility costs have reduced on average by 30% across all data sets. For the full year 2020, the data sets reveal that total costs have been stripped by 41% in the select service hotels, rising to 53% in the full service sector. Some of these reduced costs are as a direct result of hotels being closed for certain periods in the year, and hotel owners benefiting from the furlough scheme, or employees working reduced hours or moving to 0-hour contracts. However, what is clear is that despite these cost savings, they were indeed not enough to prevent the losses that have incurred. For the full year 2020, hotels which are trading as at December 2020, select service hotels have achieved a positive GOPAR of £5.60, and mid-scale hotels have recorded a GOPAR of £3. Full service upscale hotels broke even, whilst the upper upscale sector suffered a loss. When reviewing the total hotel market, i.e. hotels which are open and closed, select service hotels and mid-scale hotels continue to operate at a small profit. Looking at GOP as a percentage of turnover, select service hotels have shown their resilience in 2020, despite the toughened and more challenging conditions in Q4. For the full year 2020, select service hotels, which are open as at December 2020, achieved a GOP of 20%, a GOP percentage, of 20%, while upper mid-scale hotels achieved a GOP percentage of just under 10%. Across the whole of the regional UK, hotels achieved a GOP percentage of 5%. Whilst not illustrated on these graphs, the UK extended stay market has outperformed by a significant margin, achieving a GOPAR of £20, which is equivalent to a 42% GOP percentage. This confirms that the flexibility and the resilience of this sector under strong management has proven an advantage at this time of crisis. This final slide shows the different data sets and full year trading data, and the sample includes only for those hotels which were open as at December 2020. It's worth noting though that some of these hotels that are included in the sample may well have been closed for earlier periods during the first or second lockdown. So this final slide outlines the main KPIs. And some of the data I've already referred to during the presentation. Sadly, it makes stark reading and confirms that the significant distress that hotel owners are having to endure. Endurance is definitely the key word. Focusing more on current and forward-looking data to predict demand and adjust pricing at the right time is therefore critical going forward. We should be questioning and asking ourselves why. Should the room rate be reduced due to a lack of demand? Are you then effectively passing on the full reduction in the VAT onto the customers when at these low occupancies, select service hotels and other hotel classes can't afford to do so? Hopefully, I've shown you that some of the data, that through this data analysis, it's critical to help forecast and benchmark, much more so now during this period of profound and prolonged downturn, and as the UK hotel sector navigates a pathway to its recovery. Whilst this gives you a high-level view of UK hotel trading performance, it does outline the trends, which is why it's so important to keep an eye on the performance of both your competitors and indeed the wider market. It's likely to be the difference between a profitable hotel which has the funds able to service the debt and one that is loss-making. None of this analysis today, though, would be possible without the invaluable data that HotStats provide, and which HotStats are privileged also to collect from its contributors. So if that's one of yourselves, then I'd like to thank you. Right, if you want to receive our dashboard, please do send me an email. I'll be happy to share it with you. Thank you.
Thanks very much indeed, Philippa. Very, very interesting indeed. On Philippa's note there, to make Philippa's life a little easier, if anybody would like, we'll share those slides to anybody, but if anybody would like access to Philippa's dashboard, then I don't know whether perhaps the easiest thing, Philippa, is for you to, for us to put your email address into our follow-up email after this call. Are you happy with that?
Totally, I'll do it now for you.
Yep, marvelous. Okay, well, if you can send that to Rachel, we'll make sure that gets distributed to everybody, and anybody who then wants it can get hold of Philippa directly. Thank you very much indeed, Philippa, and thank you also, Aggie, again for your differing but interesting views of and analysis of performance, none of which makes very happy reading. But I guess the bright note is that there does appear to be a huge amount of pent-up demand. So once restrictions are lifted, at least for the leisure market, I think there's going to be a significant uptick in demand there, which I think will drive rate as well. So I guess advice to probably everybody in that area of the market, rural coastal leisure market is don't soften rate at this stage, because evidence would be that you will get your rate, and that there may even be an opportunity for driving rate a bit, but not in any way to, of course, take too much advantage. So there are a couple of people on the call who I'd like to now turn to briefly, if I can, just to give us a bit of an update. Dev Anand flagged at the beginning of the call that people might want an update on what's happening in relation to the government quarantine situation. Dev, are you there? Can you give us a quick 2 minutes on what's going on?
Sure. I wrote a piece in my weekly mailing, but I actually had cold feet at the last minute because I had some information that was a bit sensitive and a bit, I shouldn't have really had it. But the long and short of it is that the government have taken a fair while to decide how they're going to play this. There is now a 7-page document out from the government, from the Department of Health and Social Care, spelling out in words of one syllable what it means if you want to be a hotel to be on the quarantine list. It's the usual kind of, there's a million regulations as to what you've got to do and you can't do and blah, blah, blah. And it gives you a price specific parameter as to what you'll receive as the hotel, which the bottom line is it's 30 quid for the base room and 20 quid for the F&B per room per night. And once the hotel approves you as a COVID hotel, then it will require the whole hotel for, I think it's a sort of 14-day, 21-day initial period with then a rolling 7-day contract. So they can give you notice at any time. But given if you haven't got any other customers, then why not? I'm happy to sort of just tell you where you can get hold of this document, but more on a one-to-one basis. I don't really particularly want to just pass it out willy-nilly because it was sent to me in confidence. There are certain stipulations as to who can go in the room, who can't go in the room. There is a security supplier that the government will appoint who will be patrolling the corridors of your hotel. There will be a chosen ground coach transportation company, and so on and so on. I then picked up sort of the Australian experience from both a hotelier viewpoint as well as a guest viewpoint, and yeah, it's not a pleasant way of spending 10 days for the guests, I have to say, because you're pretty much locked in the room. You're allowed out for an hour for a cigarette or a walk or something. But if you've got an empty hotel, I guess you might say, well, 30 quid plus a bit of F&B revenue. Well, let's forget that. It's better than nothing. So as I say, I guess contact the DHSC in the first instance, but if you're struggling to get anyone sensible, then do give me a ring and I can talk it through. So thanks, I guess Deb. What interest would be is from the hoteliers on the call, is it worth pursuing or not?
Thanks very much, Dev. If we may, we'll put your email into the follow-up email as well. And if anybody wants to get hold of Dev directly, then you can do that. And perhaps I could now turn to Paul Charles, who's been a regular commentator on these sessions. For those of you who don't know Paul, he's leading the Quash Quarantine campaign, but is also very well connected globally in the travel sector, and as a business, the PC agency, which is a market-leading communications agency, and he used to head up communications for Richard Branson, so he knows a thing or two about what's going on around the globe. Paul, can you give us a quick update as to cut through a little bit of the government's sort of clutter and babble in terms of what's happening in the travel sector at the moment?
Yes, Roddy, that's a good word, clutter, actually. That's exactly what it is. it's changing by the day at the moment. But essentially, we're going to get an announcement this afternoon in the 5 o'clock press conference from Matt Hancock, at least that's scheduled for 5, about the new testing regime that the government is adding amid the many layers of quarantine and inbound travel regulations that are now going to exist, certainly from next Monday, the 15th. So what the government is going to outline is that anybody coming into the UK, whether from a high-risk country or a low-risk country, any country, will have to take 2 tests during their quarantine period. So you'll recall that everybody has to quarantine at the moment, wherever you come from. From next Monday, if you come from a high-risk country, and there are some 33 on the list at the moment, then you have to hotel quarantine from Monday, as Dev has just outlined. And you will have to take 2 tests to add to the test you would have taken pre-departure from the country you've come in from. So the other 2 tests will be taken on day 2 of your quarantine and on day 8. There's detail we're waiting for on how those tests will be administered. My understanding is they may well be given to passengers at the port of entry with labels, and then they take the test themselves at their own home or in the hotel, and then they are either collected or sent off to be lab tested at that point. Now, in principle, the idea makes sense because, of course, more testing is exactly what we need to see to get out of this. When you combine better testing, as other countries have done, with vaccines, then it should enable travel to pick up again, especially inbound travel. But of course, the problem is the government is now making this more complex because it's adding these testing measures to the hotel quarantine and is not giving any form of exit route or end date. And as a result of that, consumers are saying, we're not going to book anything, we're going to wait, we'll see what happens. And of course, it's leading to further destruction in revenue. So in essence, we're going to hear more this afternoon, and we'll get the full details on how it's going to work.
Thank you very much, Paul. I mean, there aren't any, as far as I'm aware, at least, there aren't any representatives from the airline industry on the call, but can these airlines survive? I mean, how long can they go on with no planes in the air?
It's a good question. I've got lots of airline clients, and they're hurting. Some are obviously benefiting from government loan schemes or bailouts. Aer Lingus yesterday just announced they were the latest to benefit from the Irish fund. British Airways, of course, have had a major loan from the government. So have EasyJet. So they've got enough, most of them, to get through as long as there's certainty from April onwards. If we get to the 1st of April and many of these restrictions, not just in the UK, but around the world, are still in place, and it damages consumer booking confidence, then there will be no revenue coming in and you will see more casualties. There's one well-known UK airline which will run out of the £1 billion that it raised last September by May, if it has no more revenue coming in. So we may well see more casualties around April, May if things don't improve. I'm quietly confident things will improve by April, May because the vaccine should be doing their work. It should enable the government to, as a result, open things up a little more. And I'm still expecting European short-haul travel to start meaningfully in May, even if not every country can be accessed. But 1st of May onwards, I still expect certain countries to open up to UK travellers and vice versa, like Greece, for example, which has very low or relatively low infection rates. So yeah, it's going to be on a piecemeal basis. We're not going to see the entire sector open up. And airlines, I think you'll see a couple more failures. And in fact, you've already seen Norwegian pull out of long haul, which is a symbol of how decline is setting in among airlines. Most are optimistic at the moment, but if this carries on after, as I say, 1st of April, that's when you're going to see heavy casualties, and you're going to see the industry, well, it's already changed for good, frankly. It will not go back to how it was in 2019 from an airline point of view.
Just on that note, what do you expect to be the key legacy of the pandemic for the airline industry?
Much less business travel. So you'll see business cabins, premium cabins ripped out. You'll see more all economy flights in short haul. You'll see business travel, I think, drop pretty well by 60% over the next 5 years, as people have got used to other methods like Zoom, like this call, for example. And you'll see definitely over the next 3 years, many consumers taking longer trips, but fewer trips, because they won't want to maximize their risk. They'll want to reduce their risk when they travel, whilst this pandemic lasts in some shape or form for the next certainly 3 years. So as a result, they'll do fewer long haul trips, and the trips they do will be longer, say 2 weeks to Europe instead of 1 week, twice a year. That's the sort of change you're going to see, and that has huge impacts, of course, on how hotels respond to those sorts of passengers.
But actually, within that, there could clearly be significant benefits to hotels as well.
Absolutely,
so,
yeah. I mean, let's not be too pessimistic. The staycation market will boom, as we've been hearing, and short haul, I think, will do very well. I think there are many short haul possibilities, meaning that you'll be able to get more revenue from longer staying guests who become more loyal because they're staying 14 nights instead of 7, for example. So yes, absolutely. There are many upsides amid the gloom at the moment.
Good. Paul, thank you very much indeed. We're sort of slightly over time, so we'll draw it to close. But thank you very much to Aggie and to Philippa. Thank you, David, for your contribution, and Dev for yours. Just very briefly to let you know what's coming up next week, we have Ian Miller, who is Senior Lecturer in Hospitality Technology from Lausanne Hotel School, who's something of a world authority on technology in the hotel sphere. So promises to be very interesting. And on a rather different note, we have Douglas Ross MP, who's the leader of the Scottish Conservative Party. They're a fairly small minority party in Scotland these days, but it'll be interesting to see what he's got to say about his views of hospitality and the recovery. The week after that, we have Peter Hancock, Chief Executive of Pride of Britain, who I'm sure is known to many of you. And I also hope that we'll have Claire Mullen, who is Head of Marketing for Visit Britain. The week after that, we have managed to secure a bit of time in the diary of the Right Honourable Lord Blunkett, who I'm sure is known to many of you and has some strong views, interestingly enough, about the hospitality sector. And his supporting act that day will be Kate Nichols, again, Chief Executive of UK Hospitality, who's very kindly agreed to join us again. And perhaps it should be the other way around. Perhaps Lord Blunkett is the support act for Kate Nichols. Thank you all for joining us. Thank you to our presenters. Thank you to our guests. Nice to see some new faces. Panos, always nice to see you from Greece. I hope you've got something to give you a bit of a smile today. Do please bring along any of your friends or introduce them if you think they would like to, they would get benefit from these sessions. As ever, great pleasure to see you all. Stay safe for another week, and we'll look forward to seeing you next Tuesday, same place, same time. Thanks very much, everyone. All the best.
Cheers, Roddy.
Thanks, Roddy. That's very good.
Very good.
Thank you,
Great
Roddy.
pleasure, Charles. Great pleasure,
Thank
Billy.
you, Roddy, for the opportunity.
Well done,
Not
Philippa.
at all, Philippa. Thank you.
Oh, great update. Thank you.
Yeah, very good. Thank you, Roddy. That was a very good session.
Great pleasure. Great pleasure, Nick. Glad you enjoyed. Actually, Nick, do you want to just stay on the line for a moment? I was trying to grab you at the end of the call last week, but you disappeared. But I wouldn't mind just having 2 secs with you if you can just hold
Sure.
the line, hold on the line for a second,
Yeah.
and I'll stop recording this session. There we go.